There are 3,265 ETFs available in Europe. Let me show you how to find the best 5 for you. The big popular American ETFs that everybody talks about, like SPY and QQQ, they are simply not available in most European countries. You put in a symbol, you click buy, and denied. Thousands of ETFs are available to us, but they have long, confusing names: accumulating and distributing ETFs, physical and synthetic ETFs. How do you find the best choice in your individual situation? I'm Tom Crosshill. I've invested hundreds of millions of euros in index funds and ETFs as a professional investor. And today I'm going to show you a detailed step-by-step screen share of how I select ETFs for my portfolio. The best ETF search tool in Europe is called justETF. No, they're not sponsoring this video. I simply love this tool. I use it every day. At justetf.com, you want to click on ETF Screener, and then you get to this page where on the right-hand side, you have a long list of different ETFs, and on the left-hand side, you have different filters. Now, the first thing you want to do is scroll all the way to the bottom and select your country. Depending on the country you choose, the list of ETFs available to you will be different. But I'm going to share a secret with you. Just because justETF doesn't show you an ETF doesn't mean that you're not allowed to invest in it. So I usually select Deutschland, Germany, and for the language, I leave English. And this gives me a look at the widest possible selection of ETFs. So I hit save. And the other thing you want to do is scroll down to ETF listing and hit show all listings. So that's going to include all stock exchanges in Europe, and it simply gives you more choice. Okay, so now we're ready to find some ETFs. If you look here at the top, you'll see that we have 3,265 ETFs available. So that's a lot. Let's try to make this list shorter. The first thing you can do is choose the asset class. Where do you want to invest? Now, you might want to invest in the stock market, so that's equity, and that's actually the example I'm going to use in this video, but let me quickly explain what the other ones are. You can also use ETFs to invest in the bond market. Now, bonds are basically loans to companies or governments, and including bond ETFs in your portfolio can be a great way to reduce your investment risk. You can use ETFs to invest in precious metals like gold and silver without actually having to buy a brick of gold and put it on your shelf and guard it from thieves and stuff. You can invest in commodities like crude oil and natural gas and agriculture. Now, honestly, I would not recommend that to amateur investors. This is quite a sophisticated practice. You can invest in crypto if that's your thing. You can invest in real estate. So this can be a passive way of investing in real estate without having to buy an apartment and take care of it and look for tenants and all that stuff. And finally, we have money market ETFs available here as well. That's actually an interesting alternative to just sticking your money in the bank. Money market funds are these really high quality short-term investments where you don't get paid a lot. You maybe get a few percent per year, but that can actually be better than what your bank is offering. Okay, so that's the asset class. But for now, I'm going to select equities. That's the stock market, and that leaves us with 1,953 different ETFs. Now, the stock market is huge. It covers many different countries, regions, market sectors, and so forth. These days, everybody seems to be asking me, Tom, how do I invest in the S&P 500? And I get it. I mean, even Warren Buffett says, never bet against America, right? But at the same time, keep in mind that America is not the whole world. There's a lot more choices available. If you do want to invest in the American market, you would go to country here and scroll down to United States, and that would give you 407 funds to choose from. But for the purposes of this demonstration, I'm actually going to go with global funds. So these are funds that invest in the whole world, okay? So I'm going to click on region and world. And now we have 576 funds to choose from. Now, these 576 funds include all kinds of ETFs. You have broad market ETFs, which are the most popular. These are the big funds which invest in the whole market. But you can also go more specific. For example, here you can choose between different sector ETFs. You have agribusiness ETFs, automobile ETFs, energy ETFs, financials ETFs, and so forth. So, for example, if you have an investment thesis that the healthcare sector is going to do great, you can focus on those ETFs in particular. Although I have to warn you, picking a winning sector is quite difficult in practice. Another thing we can choose is the equity strategy. So for example, here you'll find dividend ETFs. A lot of people love these because dividend ETFs select companies that pay a lot of dividends, and it can be a good way to get some cash flow. And interestingly, research shows that dividend-paying companies tend to do quite well over the long term in general, okay? But you also have other choices such as large cap, mid cap, small cap, growth, ETFs, quality ETFs, and so forth. This is called factor investing. This is a topic that gets quite complicated. I actually teach it in my classes. So if you want a separate video about factor investing, just let me know in the comments, okay? And then we can select funds with a specific theme. So these are ETFs which have a particular investment thesis in mind, such as artificial intelligence or blockchain or clean energy, climate change, cybersecurity, and so forth. For this demonstration, I'm going to pick what is usually the most popular choice. I'm going to focus on broad market ETFs, okay? So I'm going to go into sector and I'm going to hit here at the bottom, no sectors. So that means I don't want a sector specific fund. I want funds that invest in all corners of the economy. And I'm also going to go into theme and I will hit no theme at the bottom, okay? So that leaves us with 230 different funds available. Now, if I wanted really plain vanilla broad market funds, I would also go into equity strategy and hit no equity strategy. But there is a reason I am not doing that right now, and I will explain it in a second. Okay, so now we're looking at 230 different global stock ETFs. One of the most popular questions I get these days is, how do I invest responsibly? I don't want to invest in tobacco or weapons or crude oil. If that's you, you should scroll down to this section called Sustainability and click on Only Sustainable ETFs. And that leaves you with 116 funds. But not so fast. Unfortunately, sustainable investing is not quite as simple as just hitting one button, because everybody's opinion of what sustainable investing means is a little bit different. Some people are completely fine with weapons manufacturing, but they're dead set against tobacco. Maybe somebody else is okay with tobacco, but crude oil and natural gas and all these fossil fuels, that is totally off limits, okay? So if you want to invest responsibly, you will have to do a bit more research to investigate the particular funds that you want to buy. If you want a separate video about this topic, by the way, drop it in the comments. For now, though, I'm going to remove this sustainable investing filter and look at the whole market. So we're back to 230 funds. Now, at this point, we have already selected our investment strategy. So from now on, what we're going to do is nerd out and get really technical. We will filter ETFs based on technical differences. And the first thing we can do is go down here to use of profit. Okay, so here we have accumulating ETFs and distributing ETFs. And this is actually one of the most important choices for ETF investors in Europe. So here's the deal. When an ETF invests in a company like Coca-Cola, sometimes that company pays dividends. Distributing ETFs take those dividends and pay them out to you. The money ends up in your brokerage account. Accumulating ETFs keep that money inside the fund and use it to buy more investments. Now, in both cases, you benefit. With a distributing ETF, you get money in your account. With an accumulating ETF, the money gets reinvested. It makes your portfolio grow faster, okay? There are various factors you can consider, but usually it comes down to taxes. In most European countries, accumulating ETFs are better for taxes, because if you're not getting a dividend in your brokerage account, that means you don't have to pay tax today. Okay, the money stays reinvested, it makes your portfolio grow, and you only pay tax in the future when you sell the ETF. So that's how it works in most European countries, and that's why in most countries, accumulating ETFs are preferred. But in a few European countries, the rules are different. Now, I'm not going to get into the technical details. I actually have a video about this, about ETF taxes, in my channel if you're interested. But the basic idea is that if you live in Germany or Austria or the Netherlands or the UK or Denmark in particular, then the choice between accumulating and distributing funds is a little less clear and you may want to do some research, okay? But in most other countries, accumulating ETFs win the day. So let me select that, and that leaves us with 153 ETFs. The next technical factor we can look at is fund size. Now, technically, there's nothing wrong with investing in a small ETF. But in practice, if an ETF is very small, first of all, it can be hard to buy and sell at a good price. And second, there's a risk that the fund provider might shut the ETF down. Now, if that happens, it's not the end of the world, but it is a hassle. the money comes back to you. You may have to pay taxes. You have to reinvest it. So personally, I try to stay away from really small ETFs. So we might select ETFs which are bigger than 100 million euros, for example, and that leaves us with 100 funds to choose from. Next, we have replication method. Now, this is actually quite interesting. An ETF is basically a kind of index fund. It copies the results of an index like the S&P 500. You have physically replicated ETFs, also called full replication, where the ETF actually goes out there and buys all the stocks in the index. So that's simple. Then you have sampling or sampled funds. They are also called optimized funds sometimes. These are also physically replicated in that the ETF buys the underlying stocks, but it doesn't buy all of them. It only buys a selection that is enough to get more or less the index result. Now, in practice, these sampling-based funds work just fine. So both fully replicated and sampled ETFs can be great. And then you have swap-based or synthetic ETFs, and those are very different. Synthetic ETFs use a bunch of financial wizardry to copy the index results. And this has both benefits and drawbacks. In some cases, for example, if you invest in the US market, synthetic ETFs have tax benefits. So the result of an S&P 500 synthetic ETF is usually a little bit better than of the equivalent fully replicated physical ETF. But on the drawback side, synthetic swap-based ETFs are a little more complicated. They are a little more risky. Now, I personally prefer to invest in simple things that I fully understand, so I usually go with full replication or sampling, but this is your choice. Both choices can be totally fine. Just for this demonstration, let me select full replication and sampling, and that leaves us with a total of 87 ETFs. I'm gonna skip over provider and index family because those are not so important in most cases. And next, let's look at fund domicile. Now, this is also quite interesting. Almost all the ETFs available to European investors are based in Ireland or Luxembourg. This is for tax reasons. Now, which is better? In most cases, there's not much of a difference, but if you are investing in the American stock market, and if you are using a physically replicated ETF, then there's a tiny benefit for Irish funds, okay? In other cases, it usually doesn't matter, but for physically replicated US stock ETFs, Irish funds win out. So because we're investing globally and that includes the US, in this case, I will prefer Ireland. So let me select that, and that leaves us with 82 ETFs. The next item is interesting. It's currency hedge. So what does this mean? Well, when you invest in a stock ETF that invests in American stocks or Japanese stocks or Australian stocks, you will have some currency risk. Maybe your home currency is the euro or the Swiss franc or the pound, but you are investing in dollars and in yen and Australian dollars and other kinds of currencies. With a so-called currency hedged ETF, you can remove the currency risk. This can seem attractive, but actually for stock investors, this is usually not necessary. You actually can benefit from having a diverse portfolio of different currencies that can actually end up reducing the overall risk of your investment. Hedged funds are highly recommended if you want to invest in the bond market. But since we're investing in stocks here, I'm going to leave this unchecked. And now we're coming to the end of the filter. We have ETFs and ETCs here. Now, ETCs are exchange-traded commodities, so that's relevant if you're investing in the commodity or crypto market. You have a section on ETF listings. We already discussed this at the beginning. Basically, if you want to buy ETFs on a specific stock exchange, you can select that here, but I don't see any reason to do that. And then here at the bottom, you can choose between long-only ETFs, active ETFs, and short and leveraged ETFs. Now, active ETFs are actively managed ETFs that don't track an index. It's kind of an innovation in the market, and some people think it's a good idea, but personally, I'm quite skeptical of these actively managed ETFs because usually these professional investment managers struggle to beat market indexes and get better results. And when it comes to short and leveraged ETFs, well, those are just toxic.
Look at me, I can juggle.
I would say 99.99% of investors would be much better off staying away from those because they are an easy way to gamble and lose your money. Okay, so now we have used all the available filters, but there are still 82 ETFs on our list. So that's quite a lot. What do we do next? Well, a couple things we could do is go back and decide if we want to invest in sustainable ETFs. So that would be 48 ETFs available. Or if not, we can go to equity strategy and hit no equity strategy. And that would leave us with 19 ETFs to choose from. Now, if I chose no equity strategy, that means I want to invest as broadly as possible. So these are going to be funds that invest in the whole market, all sectors, all themes, like all the stocks in the market. This tends to be a very popular choice with investors, so let me leave this as our primary choice in this demonstration. Okay, so we've done all the filters and we have 19 ETFs, but I promised you 5, so what gives? Well, if I'm actually building my own personal portfolio, I wouldn't research all 19 of these. I would go here and click on TER, that's total expense ratio. And I want to see the cheapest funds, the funds with the lowest expenses. And then I would simply select the top 5 and open them in a separate tab and research them in more detail. Okay, I would look at where these funds invest, what the risk level is. I would read the key information document, compare these funds, and pick 1 or 2 for my portfolio. So that's how you go from over 3,000 ETFs available in Europe to 5 or even less. Now, if you live in Europe and want to start investing in ETFs, if you're wondering about which brokers to choose and how to handle taxes and all that stuff, I've got some great materials about this. So click the link in the description.